Now, as we turn to the European market, it's always important to put everything into context. And as we've said, some of the European data has gotten better. Consumer confidence still negative. It came in at negative 19, but it's better than what it was at negative 20.7. So again, you're starting to get some of that flatlining. Construction output came in at negative 1.3, which is in line with what we were talking about. And then a positive point is the Eurozone manufacturing came in below estimates. So it was expected at 49.3, came in at 48.5, but composite was expected at 50.7, came in at 52.3, driven by services. Services was expected at 51, came in at 53. That, again, was a bright spot, one that we saw slowing down in February, but they obviously shook that off. And we were dead wrong when you look at services. Manufacturing, we had seen some additional slowdown, and that's just by looking at boats, imports, exports. We thought the slowdown on import export was also showing some softness in local demand, which clearly wrong, but you're still going to get this lumpiness, but it's also going to keep the ECB raising rates. When you look at the service, we talked about how real wages are going down. Inflation still remains a problem. Survey expectations in Jan were 16.7, came at 29.7. So there's more than enough room for the ECB to take some, I would call it, it's obviously aggressive is relative because they're still so low, but it's going to keep rates going up. And again, this is where you're going to see some of these additional pressure points. Now, when you turn to Germany, PPI came in at negative 1%, which is a positive. PPI came in at 17.8% year on year. Again, showing some of that slowdown. But on the manufacturing side, as we had said, there was going to be pressure. German manufacturing was expected at 48.1, came in at 46.5. Services expected at 51, came in at 51.3. Composite was expected at 50.3, came in at 51.1. Survey expectations expected at 23, came in at 28. Current expectations situation expected at negative 50.5, came in at negative 45.1. So again, you're not terrible, but manufacturing, because it's an exporting economy, that's a problem. So services is still keeping things going, but that's where we see any of that additional slowdown is going to be a problem. CPI month on month expected at 1%, came in at 1%. Year on year expected at 8.7, came in at 8.7. So inflation is kind of sitting here, and we see that becoming a bigger issue because if you look at where they are versus the US, they're going to get stuck up there where the US came down a little bit faster. There's a lot of problems, obviously driven based on Russia, Ukraine, issues in terms of now sourcing natural gas in the shoulder season of LNG versus piped, the inability or the cost going up for gas oil and middle distillate diesel. Those are going to be pricing issues, which is why the business climate was expected at 91.2, came in at 91.1. IFO current assessment expected at 95, came in at 93.9, and that's worse than January. And then expectations expected at 88.4, came in at 88.5, kind of in line, slightly better than Jan. So you're starting to see the main message really when you look at the Germans' IFO and the releases out of the Eurozone is that the improvement in the data has flatlined. And then it even fell back slightly on the current conditions when you look at German IFO. And again, that rebound was always going to happen. We just think that it flatlines a bit here. And you're still going to be in contraction, but at the same time, some of that service piece, the inflation piece is still going to keep the ECB going in rate hikes, which again is going to depress activity further, and when you look at, again, the natural gas component, natural gas inventories are elevated, but you still haven't seen any industry turn back on. And that's where you're getting some of these different pivot points, which is why we think that there's a bit of that flatlining and pause. Eurozone confidence indicators are recovering, raising the chance to avoid a recession. But again, we don't think it avoids a recession. It's just it recovered because the rate of change has to slow. You can't go down that fast. And my old boss used to call it too much too fast. where you get this massive drop, and then but you're going to get a big pop because again, things have to revert to the mean. But then when you look at the Eurozone PMI, again, that little bit of a rollover, and that's where we see this kind of balancing out. Now, price pressures on the delivery times have gotten better. Activity components have gotten better in terms of where they are. But there's still that issue in terms of availability of power, looking at diesel, looking at electrons, looking at natural gas. And even though prices have come down, they're going to re-rate higher given where China is and how China is absorbing some of those additional LNG cargoes that they were reselling into the market. We cover that on our insights on Friday in terms of some of those LNG flows. Eurozone industrial production, new orders to inventories is the highest since May of 2022. They bottomed around October. And again, as some of that gas risk recedes, but are you going to get that manufacturing? Because manufacturing, especially in Germany, has actually gotten worse. And manufacturing consumes a lot of natural gas. So if that goes into expansion, well, how quickly does natural gas come down? Because storage come down because you can't easily replace it. Gas stores in the EU are filled to 64% of capacity, which is obviously well above average. But the question is, again, replacement cost. And, because if you think about how they got to this level of fill, they were trying to pull in as much pipe gas as possible. And then you had China that was shut down. They were reselling a lot of their LNG. And now as China reopens into kind of a normal state, relatively speaking, well, they're not going to resell the same amount of LNG, which is going to put, again, that price higher and put more pressure on the inflationary side. And again, kind of still put that cap in that slowdown, which is why we still think a recession is likely. Now, the mood among Eurozone consumers improved, but you can see it's still negative. So it's improved. It's gone from worse to just bad. But when you look at the rate of change is flatlining, it's slowing down. And that's why we think that there is continuing to be a problem. And this just puts it into perspective where there's still good news where EU consumer confidence recovered, but to the level of the great financial crisis. So again, you have to put it into context, which is why we say zoom out, because it's a good number up close. But when you zoom out, it's still historically weak. And that's where we like to balance things when we're looking at some of the data sets. Now, when you look at the money supply numbers, there's a good argument that there's a certain overstating on the slowdown in terms of pandemic savings. It's when you look at it, there's not a pretty picture when you start looking at liquidity side and trying to move that through, which is why we see rates going back up. But when you look at M1, M2, you can see that they're trying to pull some of that out, but there's been a lot of liquidity pushed into the market. I mean, the Eurozone has been running negative rates for a long period of time, and some of that has to come out to bring this insane inflation back under control. Eurozone consumer confidence, again, putting it into perspective, output. But here's an important piece, new export orders. When you look at Germany, new export orders are falling again after that rebound. And the recent market optimism in Europe will turn as you're getting, again, new orders are that key leading indicator. So you had manufacturing expected to be at 48.5, coming in at 46.5, and you have new orders coming down. So why are you going to ramp manufacturing if your new orders are so negative? And that's where we see that leading indicator and those problems continuing to persist. Services is strong. That's going to help offset some of this. So that's why you're not going to get this like, oh my God, Germany's down 15% in the quarter. Their economy, it's a steep recession. No, it's just going to be this bumping along the bottom. And I think people are misinterpreting this as in avoiding a recession. And we just don't see that avoidance. We just don't see a steep recession. And that's where, but we do see it kind of bumping along the bottom. And if you look at Japan, the pinnacle of easing and quantitative or MMT, quantitative easing, you get stagnation. And that's what you're getting. You're going to get the stagnating economy with no real movement and really kind of fixed negative growth for a long time. Instead of going down 5% quarter on quarter, then bouncing, you're going to be down 0.5%, 1%, and just kind of bump along the bottom as people struggle because of inflation, because of falling real wages, because of rates. And that's, again, not something that can be adjusted quickly. When you look at manufacturing and PMI in France for what just came out, the survey was for 51, came in at 47.9. Germany, as we said, was expected at 48.1, came in at 46.5. And that is how things are coming back down. But you can see it's just bouncing around at this slight growth, a little bit slower contraction, but the trend is the same, netting to contraction, which is why we say what we've been saying about European growth. New orders, as we showed, 40.1. Is it off the lows in 2022? Yes, but it's not increasing. France continuing to decline. More pressure, again, showing the leading indicators and where the pressure resides. And these are key exporting countries that are just not getting that demand because of slowing global demand, because of slowing trade. And this is just another bellwether. Now, the service side in France, again, same thing, better. It actually bounced higher than Germany. In France, expected 49.8. It came in at 52.8. So you have to blend the two. This is a good number. This is something that is showing that, again, people are paying higher prices. People are still expanding their credit cards, but rates, this is going to keep the ECB moving higher. French service input prices flatlined at 73. Eurozone services PMI input prices 70.7. And look at the little tick higher on the input prices. And that's what we've been saying. This is the problem when you look at what the ECB has to face. They have to try to get in front of this, and you get an idea of why there's that pin higher, why there's that additional pressure, and why we think inflation is going to remain stickier longer in Europe than it did in the US. And here are just some of those examples. And remember, services is part of sticky inflation, not flexible inflation, which is going to lead to more pain for the core consumer, more pain for the core side, and again, keep that pressure mounting, which is why the ECB is still going higher and we still see a recession in Europe. So that's what we have for you for Europe. In the next segment, we're going to go deeper into Asia, starting off with China.